Yeah, so International Accounting Standard 40 deals with investment property. Let's say this is like a property which you own. Okay, this is property one and this is property two. Both the properties are owned by you, but the property number one is used by you for your own residential purpose. That means you stay in this property, and this property you have let out to Mr. A. Okay, this property you have let out to Mr. A. Yeah, actually, like you're not audible to me, Abhishek, but okay, fine. If you have any doubts, please ask me. So this property has been let out to Mr. A. The property which has been let out to Mr. A is nothing but investment property. Why? Because this property is not utilized for our own purpose, but this property we are letting out to some individual and we are earning some returns out of this. So this can be termed as investment property. Okay, suppose this is like Mr. X, and he has this property in which he is staying, and this is the property which he has let out. Let's say he has a ancestral property like in the outskirts of the city, whereby he has 20 acres of land which he has been holding since long time, and he doesn't want to sell that. Okay, he wants to hold it, and he wants a price, he wants the price of that property to rise actually. Okay, he wants like increment in the price of the property, and he wants to enjoy those benefits. So that is also nothing but a investment property. Investment property. So any property which you have let out and you are like getting some rental income, or which you are holding since long period of time, and you want some good amount of increment in its value, that is termed as a investment property. Now let's see some definitions. Investment property is a property which is held by the which is held by the owner or the lessee as a right of use asset. If I speak about owner, it is his own property. If you have taken a property on lease, suppose there is a lessor and there is a lessee. So lessor has leased the property to lessee, and lessee has again leased the property to some Mr. X. This particular activity is called sublease. It's called subleasing. He is paying him a lease rental of 30,000 and he is collecting a lease rental of 50,000. He is collecting 50,000, paying 30,000 here and making 20,000. So this is what also some people do. Okay. And since he is not using the property for his own purpose, and he has let out the property to someone else, and he is making or generating some income out of it, it is an investment property. Abhishek, I don't understand what is this, and your voice is not audible, of course. Did you speak out something? If you have spoken out something, I did not hear anything. Can I, like, am I audible to you? Can you hear my voice, dear? Hello? Abhishek, can you hear me? Come on, I don't understand, like, what to do now. Just a second. Yeah, your mic is actually mute. Your mic is on mute. So you should unmute this. Just unmute this. Okay. Now. Yeah. So now, like, let's go ahead. So here, like rentals, capital appreciation, everything I have explained you. use in the production or supply of rather than for. That means the property which I have mentioned here, this property should not be used by you as like on for residence purpose, and also you should not run any business or any factory on the property number 2. If you do that, then this property would not be termed as investment property. Okay. Now, owner occupied property is nothing but which the owner is staying into. IAS 16 International Accounting Standard 16, which deals with tangible asset, deals with this owner occupied property. Fair value is nothing but the market value. That means if you sell the asset, if you intend to sell the asset right now, what you are going to get, that is called fair value. Cost is nothing but the what you have paid to purchase that property. Carrying amount is nothing but historical cost less accumulated depreciation of the property. So some of the examples of investment property are like land held for long-term capital appreciation, building owned by a reporting entity and leased out under an operating lease. Okay, that means you have like you have a building which you have leased out to someone under this lease, a building held by a parent and leased to a subsidiary. All these are the investment properties. Okay. Now there is an example here. Please go to this. Abu and Abhishek, please go to this example. Abu, can you hear me? Abu, can you hear my voice? Hello, Abu. Hello. Hello, Abu. Yeah, yeah, Abhishek. Now you have unmute your mic. Now I don't, again, I'm not able to hear you. Yes, okay. Like what to do now? So rich company owns a piece of land. The directors have not yet decided whether to build a factory on it for use in its business or keep it and sell it when its value has risen. That means there is this rich company. It owns a piece of land. Just a second. Yeah, Abu, can you hear me? Hello.
Yes, sir. Yes, yes.
Yeah, yeah. Abhishek, I don't know what's your problem, Abhishek. Please check it. So rich company owns a piece of land. The directors have not yet decided whether to, so this rich company owns a piece of land. Just a second, excuse me, just a second. Hello. Yes, I'm continuing, Abhishek. Okay. So this is rich company and it owns the piece of land. This is the land they own. And the directors have not yet decided whether they want to build a factory on this or like for use in its business or keep it and sell it when its value has risen. So these two things they have not decided. So would this be classified as an investment property under IAS 40? Yes, like since they have not the entity has not decided that what it will do with the property, that means it's holding the property, and definitely the capital appreciation of the property happens. Henceforth, it will be termed as an investment property. Now, coming to accounting treatment, IAS 40 investment property prescribes the accounting. So this particular standard guides you how to recognize something as an investment property, how to measure the after recognition criteria is met, how to measure this particular investment property, and what should be the disclosure requirements regarding this. Okay, and like it has been amended following the issue of IFRS 16 leases. An asset held by an entity as a right of use asset. That means you are using that asset because you have rights to use that asset because you are paying the lease rental for that under IFRS 16, and you have leased it as an operating lease, is also treated as an investment property. Now you should understand this. If they give you any kind of MCQ in the exam, this particular point is very crucial. You now know what is investment property under IAS 40. Now below are the examples of items that are not investment property. Property intended for sale in ordinary course of business will be kind of inventory for you, not an investment property. Property being constructed or developed on behalf of third parties. That means you have made an agreement with some guy, like he has the land and you are constructing the property and you are giving to someone. So it comes under revenue from contract with customers. Owner occupied property comes under IAS 16, but not investment property. Now, how will you recognize something as an investment property? Of course, if I say investment property, that means it's an asset for me. Why it's an asset for me? Because it will give me economic benefits, and also the like that will flow to my entity, and its cost should also be measured reliably. These are the two conditions for something to be an asset, and the investment property, if satisfies these two conditions, it will definitely be termed as an asset. And the initial measurement is always at cost, but the subsequent measurement is at fair value model or cost model. So what do you mean by fair value model? See, there is a small difference between investment property and IAS 16. That means IAS 40, which deals with investment property, and IAS 16, which deals with PPE, property, plant and equipment. So what is the difference? Initial measurement at cost, that means you'll show its cost. Okay, that's what they have mentioned. In all the things, whatever you have paid to buy the property, here even initial measurement at cost. Okay, now subsequent measurement either at cost or fair market value. Subsequent measurement either at cost or revaluation. Model or revalued amount. So this is what is the small difference. So why? Now you'll be asking me a question, then why this? Like why fair value market, why fair value model here and why revaluation? See, revaluation model, because you want to hold the asset. You don't want to sell the asset, but asset value may increase. Okay, when you check in the market, the value of the asset has increased. So the difference has to be accounted because you will be showing the asset at the revalued amount in the balance sheet. Henceforth, the difference in the cost and revalued amount is a gain, which is called revaluation gain or revaluation surplus. And that has to be shown, boss. Where you will show that in the other comprehensive income section. Understood? OCI section. Point number 2. Just a second. Next point. When it comes to this one, IS 40. So we like subsequent measurement is at fair market value model. That means whatever the difference in the cost and the fair market value of the asset, because now we'll be showing the investment property at fair market value. That means we expect the value to be a higher one. If it's a if the fair market value is less than cost, then it's an impairment loss. So that's a secondary matter. But if the value is more than cost, then that definitely it's also a kind of a gain. And these gains have to be shown in SOPL. Why? Because here the intention is that if we get a customer, we are ready to sell the asset. That's the reason why fair market value model comes into picture. That's the only difference. Okay. If we get a customer, we are ready to sell. That's the only that's what it means when I say fair market value model. Okay, or fair value model. So difference amount can be shown as a gain in statement of profit or loss, and in the balance sheet will be showing the asset at fair market value. Now, this I've explained everything. Cost model is like explained right now. Done. Yeah, now comes the changing models. Now, what is this changing model? See what happens. What happens? That means we have to study or discuss the concept of transfers. What is this transfer means? See, the usage of the property can differ. So I'll explain you this point here. Suppose you have an investment property, and that means you have let out the property on rental basis. This is a property and you have let out to Mr. A. What happens? You're not satisfied with this rental income, it seems, and now you want to kind of use. So here what is applicable? IAS 40. Now you want to like use this particular property for your own business. Like maybe you want to start a new company in this. So then what would come into picture? IAS 16. So from IAS 40, the treatment changes to IAS 16. Vice versa. If this property is used by you, okay, that means you are using this for your own personal purpose, then IAS 16 was applicable. But if you want to let out to someone, then IAS 40 comes into picture. Again, this will be applicable. Suppose you have a plot of land, like a big land, okay, that is in the outskirts, like 20 acres something. And this land is like held by you since long time. And it is, just a second. Yeah. So then if at all this property is like held by you and it's an ancestral property which you have, and it's a 20 acres of land. Now what you want to do is like you want to like change the use of this land. That means instead of holding this, you want to like you want to do a plotting on this and you want to sell the plots to people. Then IAS2 comes into picture, inventory. Why? Because it becomes your inventory. Or vice versa, if you are doing real estate and the properties are not getting sold, then again you want to hold it for a long period of time. Then again from IS2 it becomes IS40. Okay, so that is the condition. Now we will just do an example and understand. Please read this. Abu, are you hearing? Hello. Abu, are you following? Abhishek, are you following? Hello.
Yes, sir.
Abhishek, Abu?
Yes, sir. Yes, sir. Yes,
Very good.
sir.
Thank you. Thank you, dear. Thank you. Please read this. Please read this. Yeah, now Capital Company owns a building which it has been using as a head office. In order to reduce the costs, they were using it for their personal use. On 30th June 2009, it moved its head office functions to one of its production centers and is now letting out its head office. Thus, that means they had a property and they were using as their head office, and they want to reduce the cost now and they want to move their head office functions to their production centers. That means their factory. In their factory, they have a small like area where they can do this, and they want to let out this this particular head office to some other client or customer. Company policy is to use the fair value model for investment property. That is what they have mentioned. Building had an original cost on January 1st of this much and was being depreciated over 50 years. That means you can divide this to $250,000 divided by 50 once, I think 5,000 per annum depreciation is 5,000. Okay, and like when did they, this is like 9 years, so this property they have been using for 9 years, and like they bought it on January 1st 2010, but you know like they want to move this, that means they want to give it to someone, or they want to let out this one on June 30, 2009. That is like, so how, what's the depreciation till date? So for 9 years, exactly 45,000, that is 5,000 into 9. What they have done is like, you can follow my points, and mid year of the 2009. So that is 5,000 into 6 by 12, that is 2,500. So they have removed this and the carrying amount of the asset is this. Okay. Now the fair value, what they have like the fair value of the property in the market is this one. So this is what the fair value is, and difference, the gain is nothing but 1,47,500. See, this will be shown as revaluation surplus. Why? Because till now the property was owner occupied property. Now they are letting out it to someone. Now they are letting it out to someone. So now onwards, the property will be termed as investment property, but till now the property was owner occupied property. So this becomes a revaluation surplus or gain. That's it. Okay. So after that, the building is accounted as an investment property. Now next year, let's say the building value has increased to 3,80,000. So 30,000, the increment will be going to SOPL. That means the statement of profit or loss. It will be created to P&L. Okay. Now please check this question. Any doubts you can ask me. I'll move forward. Okay, now let's move forward. Disposals. See, if you don't want to use a property, let's say you have let out some property to someone, and now you don't want that property, don't want to own that property. So you would sell that property, you would dispose of. And then when you sell that, definitely the ownership rights are transferred to someone else and no future economic benefits it will be giving to you. So you need to de-recognize that property. That means you have to remove that property from your balance sheet. Why? Because now you don't use it. You're not using that. Okay. And since you are selling it, you may have got some gain or loss. So that you have to account in the SOPL. That means statement of profit or loss. And then you have to also give some disclosures regarding the investment property. That means what kind of model you are using for investment property, whether you're using fair value model or cost model, and like how did you classify that property as investment property, like how did you determine the fair value. Then you have taken the service of some independent professional valuer for valuing the property. That means asking the fair value of the property from him. Then what is the rental income you're getting and the expenditure what you're expending, or any restrictions or obligations on that property. That means any legal obligations are there on that property. Everything you have to disclose. Disclosures are important because the investors would come to know about the status of the property or the property which the entity is owning, which definitely belongs to the shareholders. But you know, it will be controlled by the entity. So at the end of the day, the investors want to know their property, like what's the condition of that property and all the details about the property. Okay. Fair value model, additional disclosures you have to give. An entity that adopts this must disclose a reconciliation of carrying amount. That means what was the carrying amount, what, like first year it was the cost, then every year you depreciated the asset and every year carrying amount got created. So you have to show that carrying amounts reconciliation. That means today what is the carrying amount and previously what was that, and how did you reduce the property's value every year from its cost. And also like cost model additional disclosures, like you should also show the fair value of that property, okay, in the disclosure column. So this is what we have discussed about the investment property. Now let's understand about the borrowing cost. So International Accounting Standard 23 deals with borrowing cost. This is a new standard. Okay, this is the last part of this chapter. And borrowing cost is what actually, suppose you want to make some asset or some construct some asset, some building, you will be borrowing money from the bank for that. And what, so like let's say some builder is selling you a property. So that builder has made that property by borrowing money from the bank. Okay. So builder has been paying interest on that loan. The day when you take the loan, that day, from that day itself, the banks charge interest from you. So that interest what they are paying before delivering the flat to you, they have to recover that interest from you. Am I right or wrong? Please tell me. Yes, see, this is Mr. X.
Yes, sir.
He's a builder and he is making a property, apartment or flat. He wants to sell that flat to you. So he has taken a loan to make this flat or build this flat. That loan's interest is paying since the day one when he borrowed the money to construct this building. And when he will sell the asset or this flat to you, he will charge some money from you. Let's say he charges 50 lakhs from you. Okay. That means it costed him 40 lakhs or 45 lakhs, let's say, and 5 lakhs is the profit for him. So the cost of 45 lakhs is nothing but it includes everything from raw material to construction cost to the finance cost. That means the borrowings what he has made from the bank, the borrowing cost also. Okay. So what do you think? This borrowing cost would be recovered by the builder, and how is he recovering that borrowing cost? He's adding this borrowing cost to the property value. Correct or wrong? Please tell me. That means he's capitalizing. Capitalizing the borrowing cost. What do you mean by capitalizing the borrowing cost? He is not showing this borrowing cost in the statement of profit or loss as an expense. He is just adding the borrowing cost to the asset value and recovering the money from you. That's it. Finished. So the treatment is nothing but IAS 23 is of the opinion that whatever the borrowing cost a construction company incurs should be capitalized. Should be capitalized. Okay, just read these points. Yeah. Now, borrowing cost, that is interest or other cost incurred by an entity in connection with the borrowing of funds which they have used for construction purpose. Qualifying asset is nothing but the asset which they want to construct or make, and they want to either they will use it for their own purpose or they want to sell that as an apartment or flat or something to the customers. Okay. Now, so definitely the asset should take some substantial period of time. That means, let's say you want to make this building. Generally, you know, like 2 to 5 years is what people take to construct a building. So the standard which may be included in borrowing cost, standard lists, interest on bank, the standard lists which may be included in borrowing cost, interest on bank OD and short term and long term borrowings. If you have borrowed to make that property or something, then you have to capitalize. Finance charges in respect of leases recognized in accordance with IFRS 16. This will be included in this borrowing cost only. And if you have borrowed from foreign country, so any exchange differences, which is a extra cost for you, at least which can be extra cost for you, you will definitely pass on the burden to the customer only. You will be adding that cost to the property value and you will be recovering from the customer. So exchange differences arising from foreign currency borrowings. Let's say I borrowed from US dollars. I borrowed $10,000 from United States. So exchange differences right now, $1 is like, when I borrowed it was 70, now $1 is 80. So difference has come to 10, 70,000 here. So 10,000 difference has got created. Again, that will be also an adjustment to interest cost. Depending on the circumstances, any of the following may be qualifying assets. Anything, if you want to make something Like suppose you are a builder and you are into real estate. So you want to make flats and you want to sell people. That's your inventory, na? If you want to build some plant or some research and development you want to do. If you want to lease some asset and you want to sublease that to someone. All this comes under. In all these cases, you'll borrow money, and then the borrowing cost should be capitalized. That means you'll be recovering that from the customer only. Now, as I already have explained you, capitalization is what you have to do. Borrowing cost should always be capitalized. I already told you. Okay. Now there's a question here. Please read this. I'll explain you how the capitalization happens. Okay. See, on 1st Jan 2006, Streeman's company borrowed $1.5 million to finance the production of two assets. That means the company has borrowed $1.5 million, and why have they borrowed is they want to make two assets, both of which were expected to take a year to build. That means substantial period of time is 1 year. So 1 year it is taking for them to make this asset. Work started during 2006. The loan facility was drawn down and incurred on 1st Jan 2006. So they took a loan, and from 1st Jan onwards, interest is charged on them. So they borrowed the money, but how did they utilize? Let's see. So it's like the question is indicating that whatever the money they have taken as loan, they did not utilize that entire money at once. They like some part of the amount they utilized like in first 6 months, and some rest part of the money they utilized in another 6 months. Okay, like suppose I have some $10,000, so 5,000 I utilized in first 6 months, 5,000 in next 6 months. That's what they are saying. Now let's see how. January 1st and whatever. See, if I utilize $5,000, then I have $5,000 with me left over that I will invest. Okay, and I will earn some revenue or income on that. That's what is also a condition in this question. So the loan facility was drawn down and incurred on 1st Jan 2006 and was utilized as follows, with the remaining funds invested temporarily. So if they use a part fund out of this, the other part, leftover part of the funds would be invested and some income would be generated from that. So 1st Jan 2006, asset alpha, they are making two assets now. So for asset alpha and asset bravo, these are the two assets they're making. And $250,000 they are like they have $1.5 million. So 250 they are using on the first day. Okay. And that means if we divide this 1.5 into two parts, 7.5, 7.5, let's say, that makes it 1.5. So 250 they utilized here. Okay. And let's say, let's not divide. Let's see what we are doing. So this is alpha, this is bravo. So what they did is, out of $1.5 million, they utilized 250 right now for construction of alpha and 500 for the construction of bravo. So 7.5 they utilized, 7.5 is left over with them that they are investing. How they are investing? They are investing that money. Okay, they are investing that 7.5, leftover 7.5. Okay, so they can invest it for, like, let's say, if they for a year. Okay, here next 6 months they are utilizing again 250 and 500 here. Okay, so in this way the entire year whatever they have, they are utilizing the total 1.5 million. Loan rate is 9% and surplus whatever the, suppose after using 7.5 in the first phase, they're left over with 7.5. They can invest it and they can make returns of 7%. Okay. Now see how they're doing. So borrowing cost on 31st Jan 2006, that's at the end of the year. asset alpha and asset bravo. Borrowing cost. So asset alpha is 500, asset bravo is 100, like 1000. Okay. So for asset alpha, they are using how much? They are using these two. That is 250 plus 250. Okay. That is 500. Okay. They are using 500 for this. And here for Bravo, they are using 500 plus 500,000. So like 3 zeros, if we add to this, it becomes 500,000 and 1 million. Okay. So they'll be paying some borrowing costs. So 500 into 9% is this, and 1 million into 9% is this. Okay. So these are the borrowing costs. And see, if this guy has utilized the money here, okay. So like let's say if he has like utilized 250 for asset alpha, 250 was left over, and on 250 he will be earning some interest. See, 250 he utilized. Okay, he utilized 250. So leftover was 250 with him. This 250 he invested. He will invest for 6 months. Okay, he will invest for 6 months. This whatever he has utilized is gone. Now it won't come. This he has invested. Now after 6 months, he has 250. He can invest this 250. Okay, see, understand. 250 he used for he used on Jan 1st. That time he had 250. This he has invested. Okay, this he has invested. So 250 he has used completely or invested on Jan 1st. Invested in the sense he has utilized for the project for construction of asset alpha on Jan 1st. At that time he was left over with excess 250 that he invested. Okay, for 6 months till June. Then again, when his investment has got matured, he got this money back. Okay, and also the returns. Then again, he utilized this money for asset construction. That is alpha construction of alpha. So in that way, 6 months he earned on this, and 6 months he earned on this at the rate of 7%. So he got these incomes. We will remove these incomes from the cost, and these are the net cost. So this we will add to the loan amount, what we use for asset alpha and Bravo. This is the cost we added, and this is the borrowing cost which we have capitalized. That means added to the asset value. Okay. So this is the borrowing cost, and we have added that to the asset value. We have capitalized. Why we are doing that? Because IAS 23 says that you have to capitalize the borrowing cost. That's it. So please go to this. If you've got any doubts, you can ask me. Are you following? Yes, please go to this. If you've got any doubts, please ask me. Now let's go ahead. So see now, like let's go for the next topic. So let's say in a situation where borrowings are obtained generally. See, in this question, they gave you the borrowing cost directly. Like the borrowing cost is 9%, and you directly took 9% and you applied on the loan amount. Let's say you take 3 or 4 types of loans. Let's say you took a loan, you borrowed some money from some bank X, and bank X is charging you 10% interest. You borrowed some money from bank Y, it's charging you 8%. So like that, you have some general pool of borrowings. That means you have 3 or 4 types of borrowings. And from this is a specific borrowing. That means you borrowed this much money, especially for construction of these assets, and you're paying 9% interest. But in case of general pool, that means you have 3 or 4 types of loans, and like you utilize some money from this, some money from this, some money from some other loan. So how will you decide that? See, now you have to pay interest now on that. So there should be a average rate for that. If it is the case, average rate, that's called capitalization rate. So how will you find out that? Let's see. You will do weighted average for that. We will discuss how to do that one. Okay. So Acronis company had the following loans in place at beginning and end of 2006. So 10% bank loan repayable on this date, 9.5 and 8.9. So you can see there are 3 rates. Okay, and there are some loans also, 120 million, 80 million, like that loans are given. But we want a single rate. So we will do that. We will do that. We will find out that one. How? So 8.9% debenture was issued to fund the construction of qualifying asset, a piece of mining equipment. So we are using the debenture money, the debenture amount for construction of this qualifying asset. And the construction will begin on July 1st, 2006. On 1st Jan 2006, Acronis company began the construction of qualifying asset, a piece of machinery for hydroelectric plant using existing borrowings. Expenditure drawn down for construction was 30 million on 1st Jan and 20 million on 1st October. So let's see what is happening. So this is like they are using what actually? They are using the 8.9% debenture, as they are saying, correct? So 8.9% debenture was issued to fund the construction of qualifying asset, a piece of mining equipment, and construction of which began on 2006. On 1st Jan, Acronis company began construction of qualifying asset, a piece of machinery for hydroelectric plant. And they have also given the details, but what they are asking you, calculate the borrowing cost that can be capitalized for hydroelectric plant machine. That means we are not going to take this 8.9% debenture because it is used for mining equipment construction. We are not concerned with that because they are asking us to find out the borrowing cost for only hydroelectric plant machine. Okay, so since 8.9% debenture is not used, what is used? Either this one, 9.5% bank loan and 10% bank loan repayable on 2008. Okay. And also they are saying on 1st January, 30 million was used, and on 1st October, 20 million was used. Okay. So now, first we will do what we'll do is we'll find out the capitalization rate. So this loan we will take and this loan amount will take, and we'll take their respective rates also and do weighted average. So 120 is the loan, 120 is is at the rate of 10%. Out of this total 200, and 9.5% is for this loan of 80 out of 200. So 120 out of 200 is one type of loan, 80 out of 200 is one type of loan, and their rates. And when you calculate this, you get the capitalization rate of 9.8%. Now that we can apply for these particular loan amounts. So 30 million into 9.8 and 20 million you have borrowed on October. So October, November, December, 3 months. 20 million into 9.8, 3 by 2 into 3 by 12. So your borrowing cost is 3.43 millions. Okay. Please calculate this one. I'll move forward. So this is the formula for weighted average. So you take the rate, that is 10% into one set of loan is 120 out of the total 120 plus 80. Mind it, we are not taking debenture because that is used for mining equipment, which we should not find out as per this question. We only should take those loans which are used to construct the hydroelectric plant. Into 80 by 120 plus 80. So you should calculate and you get the 9.8%. So please do this till here. We'll continue the next session tomorrow. Only some I have some points to discuss. Okay, no, I'll discuss it and wind up the chapter right now only. Why to kind of delay this? See, if at all you are using a property and when its carrying amount is more than the recoverable amount, it's an impairment loss. You should show that in the statement of profit or loss. From when will you start the commencement of capitalization? So there are three events you should see. Three events or transaction must be taking place for capitalization of borrowing cost to be started. First, you should start spending on that asset construction. You should definitely borrow and your borrowing cost starts and the activity is in progress, and then the asset is which you're doing all those activities for making this asset, for constructing this asset and using this asset for either for your use or for sale purpose. When will you suspend the capitalization? If the asset what you're constructing and whatever the active development is going on for that asset, okay, and that gets interrupted for some extended period. Suppose you're making this asset and suddenly you stop the work and like that's extending for some 2-3 months or like that, then you should suspend the capitalization. Not for temporary delays, that is for 10 or 15 days. No, the capitalization would still be there. Cessation of capitalization, that is cancellation. Once the asset is prepared or constructed and everything is done and you sell the asset to someone and recover your amount from that guy, there and then the capitalization ends. No need to capitalize further. And also you should disclose all the requirements related to the borrowing cost in the financial statement footnotes. That means how much money you have borrowed and how much you have what is the borrowing cost you have incurred which you have capitalized, and also the capitalization rate if there is a general pool of borrowing. That means 3 or 4 types of borrowings are there. Okay, so you you have to do weighted average and you have to calculate that single rate. So you should mention that single rate also what you have, if any, if at all you calculate it. Okay. With this, we end this chapter, and tomorrow I'm going to start the chapter called intangible assets. Fine. So same time 8:30. Please be ready for the class. Tangible non-current assets is completed. Tomorrow intangible assets. Thank you.